Hello, accounting superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. And today's lesson is about bank reconciliations. But before we get into that, let's talk about a couple of things here. I've got a webpage. It's called accountingsuperstars.com. I've got all my videos listed out by topic. So if you're looking for a specific topic, that's the way to go. So also hit the like button and the subscribe button, because that way people know that, or YouTube knows that you like the videos. I know you like the videos, so I'll make more for you. And in the comments, if you like, just write down topics that you'd like me to help you with. So let's get a rolling here, folks. Well, what does a bank reconciliation look like? Well, bank reconciliation is divided into two parts. The upper part here is in green, and it's the banks area. So you start with the ending cash balance per bank, and you write down things that the bank didn't know about. Well, what kind of things would the bank not know about? Well, maybe the bank made a mistake. That the bank may not know about that. Or what if you wrote out checks at the last minute and the bank hasn't had time to process them? The bank's not aware of them. Now, in the second half here, the bottom half, we've got the accounting records. So we start out with the ending cash balance per accounting records, and we write down things that the company didn't know about. Now, this could be a lot of different things. It could be, maybe there's a bank service charge. Maybe there's some sort of fee that the bank took out. Maybe the bank deposited some money into your account and you weren't aware of it. Maybe you made a mistake. So all these sorts of things can happen. Now, if all works out, what we'll end up with is we'll have an adjusted cash balance right here and an adjusted cash balance right here, and hopefully they will match. And that way you will know that your bank reconciliation worked out. Now, a good reason to do these bank reconciliations is to make sure that you've got the amount of money that you think you have. Also, it's a good way to detect fraud too, or somebody ripping you off. So good idea to know how to do them. They're really not that hard. They're kind of fun to do too, I think. So here's an example. We've got all kinds of information. This is a comprehensive example. So what I'm going to do is, in a moment, split the screen here. So we've got all these things to put in our bank reconciliation. Here's our actual bank reconciliation. And then finally, what we'll do is we'll do a little adjusting entry to get the cash adjusted to the amount that it ought to be. So folks, I will split the screen and we will get started. Here we go. Let's get this reconciliation done. So the cash balance per the bank statement is $18,000. So what we'll do is we'll put that in the upper part of the reconciliation, right here where it says ending cash balance per bank statement. So 18,000, let's drop it into place. There we go. Now the next thing is the cash balance per accounting record. So let's drop that into place. It's going to go in the second half here. This is where our accounting records are. There we are, $17,930. And checks written but not yet cleared by the bank. These are outstanding checks. Now, these would be items that the bank doesn't know about. So we'll put that in the top here, less outstanding checks. A lot of students say, hey, I can't remember. Do we add, subtract? This always gets me mixed up. It's really easy, folks. Whenever you write out checks or spend money, what happens to your money? It goes down, right? So you got to subtract. It's kind of common sense. Let's come down to number 4, folks. Company made a deposit the same day the bank created and mailed the bank statement. As a result, the deposit did not show up on the bank statement. So this is something that the bank didn't know about, at least at the time the statement was printed up. So it's for $8,000. Coming down to number 4, folks. Company made a deposit the same day the bank created and mailed the bank statement. As a result, the deposit did not show up on the bank statement. So this $8,000 here, this is an amount that the bank didn't know about, at least at the time of the statement. So we're going to put it up here in the top section of the bank reconciliation, add outstanding deposits, because this is something the bank didn't know about at the time. So we'll add it. A lot of folks say, I can't remember if we add, subtract, whatever. Well, folks, you're depositing money. So whenever you deposit money, your bank balance goes up. Okay. Coming down to number 5. On behalf of the company, the bank collected a debt due to when we get to a construction. So sometimes banks act as a middle person and collect money for the company. And so this is something that the company didn't really know about here until they got their bank statement. So it's going to go down in the bottom section. Things that the company doesn't know about goes in the bottom section. So let's put in that principal of $3,000. Let's put in the interest for $600. Now, folks, I did not enter it in as a total amount. I did not just make one entry as $3,600. So you don't want to be lazy, okay? Don't be lazy. Separate it out because we have to account for it separately. So if you list it out separately, it'll make that adjusting entry so much easier. Sometimes people like to take shortcuts, but they're really not shortcuts because they tend to make things worse. Number 6, one of the checks written by when we get to it was correctly recorded on the bank statement. However, when we get to it, incorrectly recorded the check in the accounting records. The check was written for the payment of office supplies. So let's see what's going on. So the correct and actual amount of the check was $300. The bank got it right. When we get to construction, did not get it right. So we've got to adjust this in the accounting records. So when we get to a construction, wrote it in at $30, but it should have been written as $300. So what we better do is let's add another $270 to that. There we go. Now these were for office supplies, so we'll have office supplies expense. And one more time, folks, people say, well, how did you know to subtract here? Well, they're spending money. They thought they only spent $30, but in actuality, they spent $300. So we've got to get things caught up here. So number 7, the bank made an error. You won't see this very often. A deposit of $500 was recorded as a $50 deposit by the bank. When we get to a construction, correctly recorded the deposit. So no need to adjust the accounting records, but we need to adjust up here at the top what the bank is saying. And so what we're going to do is we're going to add in what it takes to correct this. So we're going to add in $450. That is, the bank already has us at a deposit at $50, but it should have been $500. So the difference is $450. Now, what'll have to happen here is we'll have to call the bank and make sure this error gets fixed and let the bank know. But let's just, for the sake of doing our bank reconciliation, let's add in that $450 right now so we can get the thing to reconcile. Number 8, the bank charged when we get to it for a bank service fee, $10. So let's put that down here. That's something that we didn't know till we got the bank statement, and it's for $10. We're subtracting, folks. Whenever the bank takes out money, that takes away from your cash. All right. Now, number 9, the bank did not honor a check written by a when we get to a customer. The customer did not have any money in the bank. When we get to a construction, has recorded the check as a deposit and was unaware of the customer's non-payment until when we get to it received the bank statement. So this was a big surprise. It's like, wow, this customer's check bounced. So what we'll do is we'll put it down here. And we'll list it here as less returned customer's check. And if we had the check number, we would want to identify that down here too. And what we're doing is we're going to put it in accounts receivable because this customer owes us. They owe us money. Now, here's the sad part, folks, is that we're going to have to decrease our cash account by $800 because that $800 deposit, we thought we had $800, but we no longer have that. It never materialized. So we have to subtract it back out. So ladies and gentlemen, that's the end of the transaction. So let me get rid of the split. Here we go. So let's finish out this bank reconciliation. Let's see if we did it right. So let's get a grand total down here, folks. So here we go, total. So all we would do is we would add up the negative 6,000, the positive 8,000, and the positive 450. And let's get a grand total here of these adjustments. $2,450. And so let's find out the adjusted cash balance. That would be $18,000 plus $2,450. That would give us the adjusted cash balance, $20,450. So coming down here, let's do the same thing down in the accounting records. Let's get a grand total here, folks. So let's add up this column. There we go, 2,520. So let's get our adjusted cash balance. All we're going to do is take our 17,930, add our 2,520, and let's get a grand total here. And look at that, ladies and gentlemen, it balances. We did a good job. There we go. And if it didn't balance, we'd have to go back and see if we could figure out why. So it's balancing. So lastly, what we need to do is do a journal entry. So I'm going to split the screen again, so that way we can see two things at once. Here we go. So the only thing that we have to adjust for are the things in the bottom half of the reconciliation. We do not need to do any adjusting for things in the top part. It's only our accounting records. These are things that we didn't know about. So first of all, let's put in that note collected by the bank. All right, so I'm going to put it right here. I'm going to drop down a slot or two right here. Here we go. I'm sorry. There we are. Get it the right color. There we are. Note receivable. So we are crediting note receivable because our customer paid us. And folks, this is for the principal amount, and that's why it's important to list things out separately. And then let's add that interest revenue down here. Interest revenue of 600. There we are. Now that check error office supplies expense, that's going to go here in the top part. And here's where I set it right there, office expense. And it's going to be a debit for 270. And the reason why is office expense, well, it's an expense, and expenses are debits. They go on the income statement. Bank service fee for $10. Here, I put it right there. Bank service fee for $10. It's a debit. There we are. Going down here to less customer check here. Accounts receivable. Folks, that customer owes us money, so we are going to debit accounts receivable for $800. There we are. And to make it all balance, folks, what we're going to do is we are going to debit cash. Now, how did I know that? How do I know we're going to debit cash? Well, here's a couple of reasons. Is that we've got credits of 3,600. Well, that's 3,600, and that's way more than our debits so far. So to make it all balance, we need to debit cash. But there's a second way here, is that this 2520, this 2,520 is a positive number, meaning we're adding cash. So that those two things tell me that debiting cash, and we could check our journal entry too to make sure it balances. We could add up the debits, add up the credits, make sure it balances, and we are good to go. Well, ladies and gentlemen, I hope this bank reconciliation lesson helped you out. If I went too fast, just go back and rewind, watch it again, and hit that like button, hit the subscribe button, and let me know that you like these, and I'll make more of them for you. Until next time, over and out.